The gates of the city close at sundown. A merchant rides in just before they do. Dust on his cloak, a hired guard beside him, a locked chest strapped to a mule. Inside that chest is everything he owns. Coins from 3 different mints and 2 metals at 4 different weights. He's here to buy wool. In 4 months, that wool becomes cloth. In 8 months, that cloth becomes profit. Right now, it's a box of metal that a dozen men on the road home would happily kill him for. So he doesn't go to a warehouse. He doesn't go to a lord. He goes to a table. A wooden table under a stone arcade near the market. A cloth draped over it. A ledger open on top. And behind it, a man who has never sailed a ship, never sheared a sheep, never woven a yard of cloth in his life. That man is about to earn more from this voyage than the merchant will. He isn't selling wool. He isn't even really selling money. He's selling something the merchant can't buy anywhere else. Because centuries before modern banking existed, someone had already found one of the most profitable ideas in financial history. You don't need to own all the money to make money from it. To understand how that works, you have to understand how badly medieval Europe needed it. Picture the money itself. Not paper, not plastic, metal. Silver for everyday trade, gold for the big transactions, struck by whoever happened to hold power over a given patch of land. A king, a duke, a bishop, a city council. Each one issuing coins under their own name, at their own weight, in their own alloy. And here's the part people don't expect. Those coins didn't agree with each other. A silver penny from one region might carry noticeably less silver than a penny of the same name struck somewhere else, or struck a generation earlier, before a ruler quietly cut the metal content to stretch a treasury. Coins wore down. Coins got clipped, shaved around the edges by people who kept the shavings. Fakes circulated. So a chest of coins wasn't a number, it was a puzzle. Its real value depended on what was actually inside each piece of metal, and reading that took a scale, a touchstone, and expertise most people simply didn't have. Now add distance. Trade was expanding, wool moving north to south, spices and silk moving west, cloth and grain moving everywhere in between. Merchants traveled to great regional fairs and to ports that never really stopped doing business. Commerce was outrunning the infrastructure that carried it. Because to buy something far away, you had to physically carry the payment there, over roads nobody policed, through territories with tolls, bandits, and shifting politics. Across water where a single storm erased a fortune. And even if you arrived, the coins in your bag might not be the coins the seller wanted. That's the problem sitting on the table at the heart of the medieval economy. Trade had gotten faster than money. Somebody was going to get very wealthy solving that gap. But before we talk about how they solved it, we need to be careful about who they actually were. Because the word bank is doing a lot of work here, and most of it is wrong. Start with the most basic figure, the money changer. Our word for a bank comes from the Italian word for bench, banco, because that's literally what this was, a table in a public square. The money changer's job was to know metal, weigh the coins, test the purity, convert one ruler's currency into another's, take a cut. That's not banking as we'd recognize it. It's a specialized retail service, run by a man whose real product is expertise. Then there's the moneylender, a separate role and a socially complicated one, which we'll come back to, because lending sat on top of one of the most contested moral questions of the age. And then the third figure, the one who matters most here, the merchant banker. He's already in the trade business. He buys and sells goods. He owns shares in cargo. He has correspondents, partners, agents, relatives, stationed in other cities. And because he's already moving goods and information across Europe, he can start moving value across Europe too. That's the crucial distinction. The most sophisticated medieval finance didn't emerge from a separate banking industry. It grew out of commerce itself. The bank was a side effect of the trade network. The centers were the Italian commercial cities, Florence, Venice, Genoa, Siena, with correspondents in the fairs of France, the ports of the Low Countries, the wool markets of England. And the families running them built something that looks strange to modern eyes. Not one bank, but a web of linked partnerships, each with its own books and its own exposure. Which brings us to the actual question. How did any of this make money? There isn't one answer. There are several, layered on top of each other. And the last one is the one that changed the world. The first is the simplest. Exchange. The merchant arrives with the wrong coins. The changer assesses them and hands back the coins he needs, keeping a margin. Do that 100 times a day, in a city where every arriving trader has the same problem, and it adds up. A volume business built on one fact. The changer knows exactly what a coin is worth, and the customer doesn't. The second is lending, and here we have to slow down, because this is where most explanations get it wrong. Church doctrine in medieval Europe condemned usury, but the modern assumption that this meant nobody charged interest and credit basically didn't exist is simply not what happened. Credit was everywhere. Farmers borrowed, craftsmen borrowed, cities borrowed, kings borrowed enormous sums. What the doctrine targeted was profit from the loan itself. The idea that time belonged to God and charging for the passage of time was selling something that wasn't yours. How strictly that got enforced varied enormously with when you lived, where you lived, who was ruling, and what everyone stood to lose by enforcing it. So European finance did what finance always does when a rule stands between it and a profit. It restructured the deal. A lender might take a share in a venture instead of a fixed return, so the profit came from partnership rather than from time. A contract might carry a penalty for late repayment, written with a repayment date everyone quietly understood would be missed. Compensation could be justified by the lender's risk, or by the opportunity he gave up, or by movements between currencies. Some lenders operated under different religious and legal frameworks, or under license from a ruler who taxed the profits and looked the other way. The honest summary? The rules were real, the debates were serious, and the workarounds were extensive. Medieval Europe didn't abolish interest. It renamed it, restructured it, argued about it constantly, and kept lending. But that still wasn't the most profitable trick on the table. Come back to our merchant. He needs to pay a supplier in a city hundreds of miles away. The old solution is a chest, a mule, and a prayer. The new solution is a piece of paper. He hands his coins to the banker locally. In return, he gets a written instrument, a bill of exchange, instructing the banker's correspondent in that distant city to pay a specified sum in that city's currency to a specified person on a specified future date. No gold crosses the road. The gold stays where it is. What travels is the promise. Sit with how radical that is. 2 piles of metal hundreds of miles apart, neither of them moving, and value has crossed Europe. The bandits now have nothing to steal but a document that's worthless to them and traceable by everyone else. And notice what's hiding inside it. The bill was written in one currency and paid in another, at a rate agreed now for a payment made later. So the banker's profit could be built quietly into the exchange rate itself. A return that was, in the language of the contract, not interest at all, but the outcome of a currency transaction carrying real risk. Trade finance, payments, foreign exchange, and a workaround for the usury problem, all in one instrument. Add the ordinary service revenue on top, fees for holding deposits, for collecting debts, for managing money on behalf of a monastery or a nobleman or a city. And in the great commercial cities, paying someone became as simple as 2 merchants standing before the banker's ledger while he moved a number from one line to another, which points at the real revelation. Because if you're still picturing a vault full of coins, you're picturing the wrong business. Think about what actually happens when a banker extends credit. A merchant sees an opportunity today, a cargo going cheap, a wool contract he could lock in before prices move. He knows it will pay. He just doesn't have the cash right now. The cash exists in his future, not his present. The banker bridges the gap. The merchant buys. The goods travel and sell. The debt is settled. The banker takes his return. Look at what was created there. The cargo moved. The weavers worked. The shipowner got paid. A profitable trade happened that otherwise wouldn't have, because someone made the future spendable in the present. The banker wasn't selling gold, he was selling time. And that's the business, not storage, not metal. The movement of purchasing power across distance and across time, which is exactly why it was so dangerous. Because every one of those arrangements is a promise, and promises break. A ship goes down. A harvest fails and prices collapse. War closes a route or seizes goods in a warehouse. A ruler changes the value of the coinage overnight, and every contract written in it distorts. A plague empties a city. A faction takes power, and the family that backed the losing side finds its assets suddenly at risk. And then the danger every banker in history has faced. Concentration. Lending too much to too few borrowers, often the most prestigious, most impossible to refuse borrowers of all. Rulers. Lending to a king was extraordinary business while it worked. It bought access, privileges, trading rights, protection. But a king is a borrower you cannot sue. If he decides not to repay, there's no court above him and no army coming to enforce your contract. Now imagine the sequence. One major borrower can't pay. Manageable, the bank absorbs it. Then a second fails. Now people are talking, and rumors move through a merchant community faster than any official news. In a world built on personal reputation, knowing who's in trouble is the most valuable gossip there is. And here's the thing about a bank. It doesn't hold enough coin to satisfy everyone at once. That was never the business. Its assets are out working, lent, invested, at sea, in warehouses, promised for a future date. So depositors come asking. Correspondents in other cities decline to honor its paper. Counterparties want settlement now instead of at the fair. Credit closes in every direction at once. The bank isn't failing because it was worthless. It's failing because everyone stopped believing at the same moment. This isn't a hypothetical. Some of the largest Florentine banking houses of the 14th century collapsed spectacularly, and the traditional story blames an English king who'd borrowed heavily to fight a war and didn't repay. Historians now argue the picture was more complicated. Political upheaval at home, disrupted grain supplies, losses across several markets, a general credit squeeze that took down more than one house. Which honestly makes the lesson sharper, not weaker. A great bank rarely dies from one clean blow. It dies from correlated risk and evaporating confidence. So what protected a medieval banker? Not walls, not guards, not even gold. Reputation, and the information behind it. A banker's survival depended on knowing things. Which merchants honored their obligations? Which houses were quietly overextended? Which routes were open? Which harvests failed? Which prince was about to debase his coinage? Which correspondent in a distant city could be trusted with your name on a bill of exchange? The great families ran what amounted to private intelligence networks, a constant flow of letters between branches carrying prices, politics, weather, war news, and blunt assessments of other merchants. That correspondence was an asset. It let them price risk better than their rivals, and priced risk as the entire game. And they kept records. The accounting techniques refined in these Italian cities became the foundation of bookkeeping as a discipline. Not glamorous, but a bank that can't see its own exposure is a bank waiting to be surprised. Wealth like that doesn't stay purely financial for long. Families who financed rulers, cities, and church institutions accumulated something beyond money. Leverage. Access to the rooms where decisions got made. Marriages into powerful houses. Political office. Patronage that put the family name permanently in stone. No conspiracy required. It's a simple mechanism, and it hasn't changed. Money creates influence. Influence creates access, and access creates the next opportunity before anyone else knows it exists. Which brings us back to the man at the table. Look at what he built. He converted currencies for a margin, foreign exchange. He moved value across a continent on paper instead of metal, the ancestor of the payment systems clearing trillions today. He financed merchants against future revenue, commercial lending. He ran correspondence in distant cities, a global banking network in miniature. He kept ledgers that had to reconcile, and he judged borrowers by their history and their reputation, which is what a credit score is, only slower and more human. Modern banking is incomparably more complex. Central banks, deposit insurance, regulators, capital requirements, instant settlement, none of that existed, and the differences genuinely matter. But the questions on that wooden table are the questions on a trading floor today. How do you move money safely? How do you judge who will pay you back? How do you price risk you can't fully see? And how do you keep people believing in you? Because the moment they stop, it doesn't matter what your books say. So think about the merchant one last time, riding in at dusk with a chest he's afraid to sleep next to. He walked in believing his coins were his wealth. He walked out knowing better, that he could pay a supplier hundreds of miles away without moving a single coin, that he could buy today with money he wouldn't earn until spring, that his name, kept clean, was worth more than the metal in that box. The banker didn't take his gold. He took something the merchant didn't know he could sell. Because the history of banking isn't really the history of money. It's the history of trust. And what happens when people discover that trust itself can become a business. If you want to see how ordinary people, merchants, and rulers actually made and lost fortunes in the medieval world, subscribe for the next chapter.